Markets are currently closed for Monday, October 20th, 2025. When the closing bell rang on the last trading session, Friday, October 17th, BigBear AI Holdings, ticker BBAI, finished the day at $7.42. That was a drop of $0.28 or 3.64%. Now, on the surface, that's a relatively standard, albeit sharp, single-day pullback for a high beta stock. But that 3.64% slide is not the story. The real underlying tension with this company is the violent disconnect between what investors expect it to be and what its financials currently are. The expectation is that this is the next great AI defense contractor, a smaller, nimbler Palantir that could one day rival the performance of an NVIDIA stock. The reality? This is a company that has seen its stock rally roughly 79% year-to-date, while its most recent quarterly revenue actually fell 18% year-over-year. That is the entire conflict right there. You have a narrative pulling one way, driven by major contract announcements and sector-wide AI enthusiasm, and you have hard financial data pulling the exact opposite way. That 3.64% drop isn't just a drop, it's the feeling of that disconnect. A minor tremor in a stock that is walking a high wire between incredible potential and profound fundamental weakness. The common belief, the story that gets told in trading forums and on social media, is that BigBear AI is perfectly positioned. It operates at the intersection of two of the market's hottest sectors, artificial intelligence and national security. The expectation is that in a world demanding better predictive analytics for defense, intelligence, and border security, BBAI is a clear winner. You see the chart, you see the year-to-date gains that look more like Tesla stock in its prime, and you assume the business is firing on all cylinders. This is what gets retail traders, perhaps using the Robinhood app or SoFi Invest, excited. They see a sub-$10 stock in a headline-grabbing industry, and they see an opportunity. But the deeper reality is far more complicated and, frankly, far more dangerous. The market is pricing this stock based on a backlog of future work and a massive pile of cash on its balance sheet, while almost entirely ignoring the disastrous operational performance it just reported. The challenge for anyone looking at this name, whether it's for a quick trade on Interactive Brokers or a long-term hold in a Fidelity IRA's account, is to figure out which of those two narratives is going to win. Is the future potential real enough to justify the present lack of performance? Let's break down the recent action and the data that's causing this friction. That 3.64% slide on Friday came after a period of intense volatility. The stock's 52-week range is a chasm, stretching from $1.51 to $10.36. This isn't a stable blue chip like Apple stock that you buy and hold in one of those automated Schwab intelligent portfolios. This is a pure high-stakes speculation vehicle. The trading volumes are often erratic, surging on news of a new government partnership and drying up just as quickly, leaving holders stranded. The implied volatility figures for BBAI have been astronomical, recently hovering north of 130%. This signals that the options market is pricing in truly massive swings in the near future. This volatility is a direct result of the Q2 earnings report that landed back in August. It was, to put it mildly, a catastrophic miss. Wall Street was looking for revenue of about $40.6 million. BigBear AI delivered $32.5 million. That's not a small miss. It's a gaping hole. And it represented an 18% decline from the same period last year. In a sector where companies like Palantir are posting 39% revenue growth, an 18% decline is a 5-alarm fire. But it got worse. The earnings per share miss was just as bad. The consensus was a loss of about $0.06 per share. The company reported an adjusted loss of $0.71. And then the knockout blow. Management completely torpedoed its full-year guidance. They had previously told the market to expect full-year 2025 revenue between $160 million and $180 million. In the Q2 call, they slashed that forecast, guiding down to a new range of $125 million to $140 million. If you take the midpoint of that new range, it suggests the company is on track for a 16% annual revenue decline. How, I ask you, does a stock sustain a 79% year-to-date rally when its own management is guiding for a 16% drop in sales? This is the central contradiction. The stock's performance and the company's performance are not just disconnected, they are moving in opposite direction. The company also reported a staggering net loss of $228.6 million. Now, we have to be fair here. That $228.6 million loss wasn't all cash-based. A huge chunk of it was from non-cash charges, like goodwill impairment and derivative revaluations. This is complex accounting that stems from its SPAC merger and acquisitions. It's not like they burned that much cash, but it still paints a picture of a company struggling with financial discipline and integration. So, why isn't the stock trading at $2? If the operations are this bad, why did it close at $7.42? This is the other side of the story, the expectation side. The bull case for BBAI rests on two pillars and two pillars only: its cash pile and its contract backlog. First, the cash. As of the end of last quarter, BigBear AI had $390 million in cash on its balance sheet. With a market cap of around $3 billion, that is a very significant safety net. This cash gives them a long runway. They can afford to lose money for several quarters or even years as they invest in R&D and try to secure larger, more stable contracts. This cash pile is the single most compelling bullish argument. It gives them survivability and options. They can even go on the offensive and make acquisitions, as they did with Pangiam. This is not a company that is in danger of going bankrupt tomorrow. That $390 million buys them time, and in the world of government contracting, time is essential. The second pillar is the backlog. The company reports a backlog of approximately $380 million. This, combined with the cash, is what investors are buying. They are making a bet that the $380 million in future booked revenue will eventually convert into actual revenue and someday profit. The bull thesis is that the Q2 revenue miss was a temporary blip, an air pocket caused by delays in U.S. Army contracts and programmatic shifts. The bulls are looking past that 18% decline and looking at the recent contract wins. They secured a partnership with SMX to support the U.S. Navy's UNITAS 2025 maritime exercise. They have their VeriScan biometric system live and processing passengers at Nashville International Airport. These are tangible, real-world applications of their technology. The market sees these announcements, sees the $380 million backlog, and decides that the future is more important than the present. This is a classic growth stock mentality, but it's being applied to a company with negative growth. It's a paradox. What does BigBear actually do? The company provides mission-ready AI and decision intelligence solutions. Its customers are almost exclusively government and defense-related. We're talking the U.S. Army, the Department of Homeland Security, and the broader intelligence community. They have two key platforms. One is Conductor OS, which is described as an autonomous command and control platform. The other, from their Pangiam acquisition, is their Vision AI and biometrics platform, which includes the VeriScan system being used at Nashville International. Their business model is entirely dependent on winning large, multi-year, lumpy government contracts. This is not a smooth, predictable, recurring revenue business. It is a whale hunting business. This makes it incredibly difficult for analysts and investors to model their revenue from quarter to quarter, which is exactly why that Q2 miss was so severe. When a contract gets delayed or a government agency shifts its budget, BBAI's revenue can fall off a cliff, as we just saw. This is a tough business to be in, and it puts them in direct competition with the 800-pound gorilla in the room, Palantir. The comparison to Palantir is unavoidable, but it's also brutal. Palantir is larger, more established, profitable on a GAAP basis, and, as mentioned, grew its revenue 39%. BBAI is smaller, deeply unprofitable, and its revenue shrank